Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, it's been less than a month since the Silicon Valley Bank collapse, and it seems as though markets feel very comfortable that all of that is in the past. And I think it's really important to understand, while maybe it is, and we hope that there's no further banks that will also collapse, there are likely many significant ramifications and impacts. And for that, I wanted to get some Wall Street experience from a veteran on Wall Street, and that is Gary Shilling. He joins us now. He's the president of A. Gary Shilling and Company, which is an economic consultant and also investment advisors. Gary, great to be able to have you with us and to get your perspective and really share your thoughts with our viewers, which is rare. So thank you.
It's interesting. There are interesting stories about great waves that have hit islands in the Pacific, and these tidal waves come in, and everybody worries about it, and they rush back to the beach, and the wave seems to go out, but then there's a secondary wave that comes in and does all the destruction and catches everybody unaware. That may be a good analogy, Catherine, because we have seen the bailouts, if you will, the backstops of the banks, Silicon Valley Bank, other banks in the U.S. that have basically failed because of runs on the banks. But the after effects are what are only unfolding now. It's making everybody very cautious. Consumers worried about their deposits. It sure looks like there is a bailout mentality, but people still worry, and they've moved their money to stronger banks. They moved it to money market funds, to Treasury, U.S. Treasury obligations. And then there is the idea that banks are going to be very, very reluctant to lend now because they just don't know where they stand. Businesses and consumers very hesitant to borrow. And we're already seeing an economy which is slipping. Just had a report on manufacturing, Purchasing Managers Index report, which was pretty much down across the board in employment, new orders, backlogs, everything else. We're probably in a recession that started maybe beginning of the year. We won't know for months until it's officially declared. But we're in a situation now where this aftermath of the bank crisis is really just beginning to roll out.
And yet it seems, when you're looking at the equity market, not that should be our leading indicator in terms of what will happen next, but it does seem as though investors feel comfortable with that type of risk exposure. How do you figure that out?
Well, all you can say is that markets can remain irrational a lot longer than I can remain solvent, and I think a lot of people are being overly optimistic. They have been. If you look back since the beginning of last year, you had a very interesting pattern. Stocks have been declining on balance, but it's been a sawtooth pattern along a declining trend. What's happened is that there's been enthusiasm. There's been the feeling that the Federal Reserve is about ready to reverse gears, to shift from restraint to ease. And then the Fed comes in, particularly under Chairman Powell, and says, no way. And you get a sell-off in stocks. So you've had this pattern of a sawtooth decline, a declining trend. And I think that's where we still are. There is this periodic enthusiasm, and investors have not yet reached what I graphically call the puke point. The puke point is where people want to regurgitate their last equity and never buy another one. And that's the sign of a good bottom in stocks. As long as people are enthusiastic, and particularly now that the Fed has resolved to knock down inflation, the Fed, I wouldn't fight the Fed, but a lot of people are.
Right. But I guess one of my questions, though, in terms of not fighting the Fed, because Fed Chair Jerome Powell is very adamant that he's going to continue to raise rates. And in some ways, we are still seeing, correct me if I'm wrong, but inflation on the services side. And as I think you point out, the labor market is stubbornly strong. So that does give him perhaps a reason to continue to raise rates. But at the same time, too, what happened with SVB and the fact that the lending standards have tightened to such a degree, is that not in and of itself a very powerful deflation effect on the economy? Long question. We'll take a quick break. We'll be right back.